The thing that scares me the most this year and every year is making stupid mistakes. And I would suggest that this audience, before you worry about inflation, which I'm worried about, before you worry about a recession, which I'm worried about, before you worry about the idiocy with which people vote, which I worry about, you worry about being an idiot yourself. So I would suggest I would start with that. Now, inflation. I believe that most people in the world view inflation from the prism of the CPI, the Consumer Price Index. And I think that's a big mistake. I think it's a big mistake for several reasons. The first is that the CPI is, quote, hedonistically adjusted, which means that the framers of the index decide arbitrarily the value of the computer you buy and the house you rent, irrespective of the market, which is to say that the inmates run the asylum. But that's not the worst problem.
In a recent discussion, Rick Rule shared his primary concerns for the economy, backed by compelling data. He highlighted the potential risks of inflation, emphasizing that for many, inflation is running closer to 7% compounded, rather than the reported 2.7%. With nominal interest rates rising rapidly and liquidity tightening, Rule expressed nervousness about the delayed impact these factors may have on the economy. His special fear lies in the high-yield or junk debt market, particularly the vulnerability of ETFs holding illiquid securities. These insights shed light on critical issues investors should consider. Don't forget to like, share, and subscribe for more valuable insights, and remember to turn on post notifications to stay updated on our latest content.
A different problem is that the CPI, when it's inconvenient, doesn't include food or fuel. Can you imagine the relevance to somebody like me of an index that doesn't include food? Silly. But that's not the worst part. Brace yourself for this, because you don't think about it. The CPI doesn't include the largest cost component of your cost of living, which is tax. Now, if I didn't have to pay the tax, I wouldn't bitch quite so much about the index. But the truth is, when I backtest the price escalation of the basket of goods and services, not that tax is actually a service, that I consume, my belief is that the purchasing power of my savings is declining at 7% compounded in US dollars, the strongest currency in the world. So when people tell me that inflation is less of a concern because it's 2.7, my response is hedonistically adjusted for people who don't drive, fly, or eat, and people who don't pay tax. For the people in this room, inflation is running at about 7% compounded. So think about this. You put money in a 10-year Canadian Treasury or 10-year US Treasury, you're getting paid 4% in a currency that's declining at 7%. That means that the 4% yield you get is costing you 3% a year. Anybody who isn't concerned about inflation is somebody who can't do arithmetic. The US dollar, like every other currency in the world, is a floating abstraction. My friend Doug Casey famously says that the US dollar is the worst currency in the world with the sole exception of every other currency. So if you measure the US dollar against the euro, or I dare say the Canadian dollar, or against the yen, or against the yuan, or against the rupiah, the dollar will do well. And it will do well for 30 years. If you measure the dollar against the dollar, which is to say you measure the net present value against the value of the dollar as a brand, then you have reason to be concerned. The idea, as an example, that the dollar is going to be eclipsed by the BRICS is silly. Doug Casey again. The dollar, quote, is an IOU nothing. The euro, because there's 16 people in the constituency, is a who owes you nothing. The BRICS, given the unconvertibility of the underlying currencies and the untransparency of the nations supporting it, is a nobody owes you anything. So you do want to IOU nothing, or do you want to nobody owes you anything? Which is to say, to quote another really famous commentator whose name escapes me, the dollar's the prettiest mare at the slaughterhouse. It'll be around in ugly form for the balance of my lifetime. For the record, I'm a fairly healthy 70-year-old. I'm an old-fashioned guy. I measure my wealth in a less efficient medium of exchange, which is gold. I actually backtest my expenditures, my savings, and my net worth. I measure it in dollars too, because it's easy, but I try and maintain a golden constant so that I have the ability to frame my discussion with myself about my family's finances in gold. I love the fact that the world has a bunch of currencies, including things like Ethereum and Bitcoin. I love the fact that there's organizations around the world, given that I'm a consumer of currencies, who are trying to invent currencies that suit me better as a consumer. Right now, the most useful currency on the planet is the US dollar. I suspect that the most stable currency on the planet is gold. I'm impressed that the Fed has had the courage to shrink the balance sheet. I'm impressed, too, with the stability and the durability, particularly of the U.S. economy. I would have expected, with nominal interest rates rising as rapidly as they have, that the destruction of the economy, that the destruction in spending around consumer durables would have been much more severe than it has been. That our debt, including off-balance sheet obligations, was greater than our ability to afford it. The way we dealt with that is we inflated away the net present value of the obligations. My fear is that the impact of higher interest rates and reduced liquidity via the M2, that the punch has been felt, but it has a delayed impact. In other words, my nervousness, and by the way, I'm no economist, my nervousness is that just because we haven't felt the impact of it yet, it doesn't mean that the impact won't follow. But I have to say I'm delighted to have been as wrong as I have been for as long as I have been wrong on that. There's too much complacency in the economy. Black swans are by definition black swans. You don't know where they're going to come from. And I would suspect that a lot of the strength, at least in the markets, particularly the bond market, which is completely illogical to me, has to do with too much complacency. I remember my own actions leading up to 2008. I remember very well driving up the 405 freeway in Los Angeles, northbound, and there was a big billboard on the right. It said, "Borrow 125% of the value of your home. Bad credit, okay." And I remember thinking, I'm not a real estate guy, but I am a lender, and that doesn't sound very cool to me. Now, if I was a logical, rational human being, I would have started selling stuff with my phone the second I saw that call, but I was complacent. Your expectation of the future is set by your experience in the immediate past. And I am terrified, literally terrified, about the prospect of a liquidity squeeze. The consequence of that is, despite the fact that I'm receiving negative real interest rates on cash savings, I have a lot of cash savings. I believe that the negative real interest rate that I suffer is an option payment on having liquidity so that I can take advantage of a market crash rather than being taken advantage of. My special fear, since we're talking about fears, is high yield or junk debt, corporate debt. In the US, and they probably have them in Canada too, I'm just not a victim of this up here, they have several $1 trillion in ETFs that are junk bond ETFs. The, sort of $5,000, $10,000, $15,000 investors, we so inelegantly call them the yield whores, have decided to buy these high yield ETFs because the topco, the ETF itself, is so liquid. But the ETF owns a whole bunch of illiquid securities that comprise this liquid cover. If you had the beginnings of a credit contraction like we had in real estate in 2008, and the junk debt market started to sell off, and people began to redeem their ETFs, the ETF manager will sell the most liquid holdings they have first. In other words, their best debt goes first. And then they get stuck with stuff that's both lousy and illiquid. There was a phenomenon back in the junk bond days, the Drexel-Burnham days, of an owl bond. An owl bond is when you call your broker and say, sell, and he or she says, to who? To who? And my real terror is that there's a run on the bank with high-yield ETFs, with no federal government necessarily able to bail them out. If you want to ask me what keeps me awake at night, that's what it is.
In today's discussion, we dove deep into the concerns and insights shared by Rick Rule, shedding light on crucial aspects of the economy. From inflationary pressures to the risks associated with high-yield debt, Rule's analysis provides valuable perspectives for investors. Remember, staying informed is key to making sound financial decisions. If you found today's video helpful, don't forget to subscribe to our channel, like this video, and share your thoughts in the comments below. Your engagement helps us continue to bring you quality content. Thanks for watching, and we'll see you in the next one.